India is a massive global economic powerhouse, and with that comes a huge appetite for energy. But this hunger for oil, well, it also creates a major vulnerability. So, how does an economy this enormous handle the jolt of a global oil crisis? The answer is pretty fascinating, actually. It's all in a unique policy structure, one that makes it both incredibly fragile and, at the same time, surprisingly resilient. So here's how we're going to break this down. First, we'll get a handle on India's tricky position in the whole global oil game. Then, we're going to dissect what actually goes into the price of fuel. After that, we'll run a little stress test, a simulation of a major crisis. And finally, we'll unpack the tools India uses to manage these shocks and look at its long-term game plan. All right, let's start with this idea of a tightrope. It's the perfect metaphor, really. India is walking this incredibly fine line, right in the tense, awkward middle of the world's energy system. And the core of this vulnerability, it really boils down to this one number you see here, over 85%. Think about that. Over 85% of its crude oil is imported. That means its entire economy is fundamentally tethered to any price spike or supply disruption that happens anywhere else in the world. This isn't just some small variable. It's a massive macroeconomic risk. This creates a really fascinating tension. Unlike smaller countries, any oil shock sends huge ripples through the whole nation. But unlike the world's wealthiest nations, India can't just, absorb the higher costs without some pretty severe consequences. And it's this unique blend of being vulnerable yet resilient that shapes its entire approach to energy. So how does India manage this balancing act? Well, to understand that, we have to look under the hood at how fuel prices are put together, because the way they're structured is both a cushion and a curse. It's a heavy burden for consumers, for sure, but it's also an incredibly powerful tool for the government. Just take a look at this breakdown. The final price you pay at the pump is a wild mix. The actual base price of the fuel itself, that's a surprisingly small slice of the pie. The rest, these huge chunks you see, are taxes, both from the central government and the states. It's as much about fiscal policy as it is about geology. And this is really the core of India's system. Fuel prices are designed to be structurally high, mainly because taxes make up such a massive portion of the cost. Now, that's a constant drain on people's wallets, no doubt. But it also creates this unexpected buffer when a crisis hits. This big tax slice creates something economists have a fancy name for, a policy-controllable wedge. But really, all it means is that the government has a built-in shock absorber. When global prices go through the roof, the government can shrink that wedge by cutting taxes, and that cushions the blow for consumers. It's their number one tool for crisis management. Okay, so we've got the theory down. Now let's really put this system to the test. Let's run a hypothetical crisis at one of the world's most critical energy choke points and see how India's system holds up when things get really intense. This is the Strait of Hormuz. You can think of it as a vital artery for the entire global economy. As this chart shows, about a fifth of all seaborne oil squeezes through this narrow channel. So any disruption here, well, that's not a regional problem. That becomes a global crisis almost overnight. And this leads us to the big, scary question that a lot of Indian consumers probably think about. In a true worst-case scenario, how high could prices actually go? I mean, could we really see petrol hit 200 rupees per liter? Let's just do the raw arithmetic here. A jump in crude from, say, $80 to $150 a barrel. That alone mechanically adds about 35 to 40 rupees to the price. Then the rupee would almost certainly weaken in a crisis, adding even more. So based on pure market forces, prices could easily push toward that 150 rupee mark before the government even lifts a finger. However, actually hitting 200 rupees is an extreme long shot. Why? Because political reality is a very powerful brake. A price hike that big, that fast would be politically explosive. The public backlash would be so immense that it would force the government to step in and use that policy wedge we just talked about. So what's actually in the government's playbook to prevent that kind of extreme scenario? Let's break down the mechanics of how India manages a crisis. It's really interesting to compare India's approach with China's. India uses high, very visible taxes and lets consumers feel the price swings, but then it intervenes by cutting those taxes. China, on the other hand, prefers to keep pump prices much smoother, but the cost of a shock doesn't just vanish. It's often hidden away on the balance sheets of huge state-owned companies. Now, India's response isn't just a single action. It's really a strategy that plays out across three different time horizons. In the short term, it's all about smoothing out the crisis. In the medium term, it's about building resilience. And in the long term, well, that's about a complete redesign of its energy demand. So, in the short term, the main goal is just to buy time and prevent a panic. And this is where that policy wedge becomes critical. The government can cut central and state taxes, it can pressure oil companies to absorb some of the costs, it can tap into its strategic reserves, and it can get very creative with where it buys oil on the open market. But look, just surviving the next crisis, that isn't the ultimate goal. The long-term strategy is way more ambitious. It's about redesigning the entire system to be less vulnerable in the first place. This is all about hedging the future. And this hedge has three powerful parts. First, ramping up ethanol blending to directly reduce how much crude India needs to import. Second, pushing hard for the adoption of electric vehicles, especially in those high-volume 2- and 3-wheeler segments and for city buses. And third, using India's massive renewable energy capacity to electrify more and more of the economy. And this really brings us to the core strategic idea here. The question isn't whether India can survive the next oil shock. It can. The real game is about speed. Can India accelerate its energy transition so that each future shock is just a little less painful than the one before? This isn't just about climate policy. It's a form of national economic self-defense. So I'll leave you with this final thought. There's a race happening right now. It's a race to see if India can fundamentally rewire its energy demand before the next major global oil shock hits. If it succeeds, the next crisis might just be a problem for the world's oil producers and not for the people of India.